All right, hi everybody. Thank you for attending today's panel on investing towards a better planet. I'd like to welcome my guests. I'm Jim Cooper. I am founder at Braid Theory. We are a vertically integrated venture advisory and accelerator as a service in San Pedro, California, in the heart of the harbor, as we say. I'd also like to welcome to the panel esteemed guests, Monica Varman. Monica is an investor at G2VP, a venture capital fund focused on sustainable innovations in traditional industries such as energy, agriculture, and mobility. She previously worked at Tesla. Did you really? Cool. In the business operations team and at McKinsey & Company in the sustainability practice. Welcome, Monica. Thank you.
Excited to be here.
Dan Lichtenberg has spent his career in software and data, from Wall Street trading floors to building startups with social and climate impact. He's now investing in early stage climate tech startups as founder and managing partner at Keiki Capital. Dan, welcome.
Thanks.
Thanks for being here. And Adriana Embus-Figueroa is fund management analyst at the Los Angeles Cleantech Incubator. In this role, she manages the Lacey Impact and Debt Funds and supports entrepreneurs in accessing and securing capital from investors in clean tech. Adriana, welcome. Thank you for coming.
Thanks for having me.
So I wanted to start off the conversation here today. There's a number of ways, I suppose, that we view ourselves as investing in the market. I want to kind of know a little bit about the role of each of you. I guess we'll start with Monica and what the role of each of you are in the ecosystem, what stage in the investment life cycle, and give us a little bit of a rundown of some of the portfolio management that you're currently doing in your organization.
Sure. So G2VP, we're a late stage venture early growth fund. So we typically invest at Series B and later. In the life cycle of a company, it's typically once a company has de-risked technology, has product market fit for a first product, and is really starting to scale their commercial engine. So our skill set and what we help companies with really is professionalizing and scaling a sustainable growth engine. And also as companies go from, say, 50, 100 employees to really 200, 300 employees, a lot of cultural performance management processes start to need just leveling up and retooling. And so we help companies really build for scale. So that's the stage at which we invest. In terms of portfolio management, we make 14 investments a fund. We don't have a massive portfolio that we're managing, but we all take active roles where we typically take board seats and help companies with both strategy and then more governance, obviously. And the big levers that we usually are pulling are helping companies with hiring and leveling up their talent pool, and then also helping them with firming up organizational processes. So things like setting up OKRs, figuring out how to scale culture, figuring out compensation at scale, et cetera. And then eventually getting ready for an exit, often in the public markets, which is its own set of it's a big organizational growth inflection point. So that's kind of where we see how we support the life cycle. We typically write $10 to $50 million checks and are invested at any point between Series B and pre-IPO.
All right, so a lot of these are internal mechanisms within the startup or scale up, and you're improving that by deploying capital correctly. Yeah.
Mm-hmm.
Excellent. Adriana, would you give us a bit of a rundown about your role at Lacey? We don't call it Lacey anymore, right? We call it Los Angeles Cleantech Incubator. I remember when it was still a Lacey a long time ago, so I apologize, but yes. Can you tell us a little bit about your role there and what Lacey is doing currently in the marketplace and in the ecosystem?
Absolutely. Yeah, so we go by Lacey, Los Angeles Cleantech Incubator, and we're much earlier stage. So we're pre-seed all the way to Series A and maybe Series B. we are an incubator at heart. So we, are founder focused, and we have kind of wraparound programs and services that are available to our founders. Really what we work on is making sure that we have a curriculum for our founders to establish everything from their business model to really understanding their mission and vision, all the way to how do you attract investors in the area and the network. We offer access to entrepreneurs in residence as well as mentors. And we also have an entire program team that's able to give full time to our startups. So we take sweat equity when our startups come into our programs. And then actually, so my role is kind of hybrid investor in residence, and where I manage a small and mighty $5 million impact fund. So we have made 10 investments over the past year. Our check sizes are anywhere from 100 to 500K, and we invest in those seed to Series A rounds. And what we've seen is most of our investments, or kind of our tech priorities, land in clean transportation, zero emissions mobility, renewable energy, as well as circular economy. So kind of thinking about the life cycle of a product. And we have a lot of our work is also thinking about policy that promotes clean tech, as well as thinking about inclusivity within the sustainability space, and how we bring folks to the table who aren't necessarily active in our conversations.
So is that equity, social equity, is that a foundational aspect of the Los Angeles Cleantech Incubator? Is that something that is a focus?
Yeah, absolutely. We talk a lot about, are you talking about diversity, equity, inclusion, or equity stake that we take?
Well, no. More the social equity, the things like environmental justice, those kinds of aspects.
Yeah, it's huge in the kind of groundwork, or the foundation of who we are as an incubator, all the way from our CEO to kind of the folks that work within our entrepreneurs. And actually, we really think about and talk about during our curriculums how folks can think more about impact. Actually, I developed an impact framework while I was there with the rest of my team. And what we do, Lacey is the first to do this in the country, where we offer an equity earn back program. So over the course of their 2 years, if startups are able to, and I'll talk more about this during the panel, but if startups are able to scale up their impact over their 2 years with the program, they actually earn equity back. And so that's our commitment to impact and social and climate justice.
Great. Well, we're going to get into impact a little bit later, as you know, but we'll get to Dan right now, and we'll talk to him about what he is doing currently in the investment space. Dan.
Yes, great, thank you. So Keiki Capital, we focus on, or I focus on, so I guess, the perspective that I'm bringing is I'm a sole GP, and so, yeah, I guess like sort of, the pluses and minuses of that is that, in terms of, portfolio management and working with portfolio companies, that it's much more ad hoc. It's much more of like sort of where does my skill set line up with exactly what the problems of the day are, and that can mean sometimes I've sort of jumped in and like written code over a weekend and like sort of contributed that to developing an idea, and sometimes it means sort of connecting with my networks that are in banking, investment banking, yeah, I think I'm excited to continue to see like all of the ways as the portfolio grows that I can sort of bring my resources to bear. Yeah, we're doing $100,000 to $200,000 checks in primarily seed companies and pre-seed as well, and maybe the occasional Series A is sort of the profile of what we're looking to invest in.
Excellent. So I wanted to get right into talking about the environment, given that this is the Earth Summit and we're thinking about investing towards a better planet. The role of ESGs has been increasing over the last couple of years, and certainly as the Sustainable Development Goals as well from the UN, and aligning with those. I know at Braid Theory we take a lot of, given that we're in the ocean and maritime space, we pay a lot of attention to that. It's an important aspect of how we look at companies, and so I wanted to get a feel of how you guys align with the SDGs and the ESG goals, and what that looks like from a not solely from the investment point of view, but how that aligns with what the needs of the startup are, or perhaps the way that capital might be deployed. I mean, are there unique ways in which capital gets deployed as opposed to a regular startup that's maybe helping you buy on Amazon or something? Yeah, give me a rundown of how you do that. And Adriana, we might start with you today for that.
That sounds good. Yeah, I mean, for us, a lot of the work that we do is really thinking about ESGs through the framework that I was talking about. So the need currently in the market is so high that every single fund I find, especially that invests in sustainability or invest in some type of socially minded focus, has their own type of framework or metrics or any type of system to be able to enumerate what a startup or how a startup is impacting its customers, its ideal market. And so for us, we took ESG as a sort of model for us to say, okay, what is it that Lacey itself as a Cleantech incubator focuses on? So of course, all of our companies align with Cleantech as in their mission. That's one of the main things. Are they avoiding GHGs? Are they diverting waste? Are they finding a way to be able to create renewable energy? But in addition to that, so we have that environmental impact. We also have two other kind of primary focuses, which are economic impact and social impact. And so economic is really thinking about the involvement in our communities, right? So is there a job creation sort of aspect to your company? Are you thinking about hiring from underrepresented groups, or is there a way to work with workforce development programs that are in the area to bring folks into your startup? And then on the social side, it's really thinking about governance and also diversity within your leadership and your board. And so one of the ways in which we do this, which I was talking about earlier, is at the beginning of the program, we sit down with our companies and say, okay, we believe as an incubator that not only can you build a successful company and make, all of these profits, but you can also impact the world that you're working within, especially because you're a clean tech company or a company focused on sustainability. So over the course of their 2 years or 1 year with us, if they're able to scale their impact, then they're able to get some equity earned back. I know that's really hard. So for our fund, it's a little bit different because of LPs' interests and all that. But really what we're trying to focus on is making sure that at the founder level, impact isn't thought about after you have 400 employees to or 1,000 employees, because we find that that's just too late to start thinking about impact, but rather when it's a 1, 2, 3 person company, and when you're really able to say, okay, let me make sure that it's part of my actual mission and vision.
So then, Monica, I guess sometimes people think that, Series A, B, C, and beyond is kind of a little bit more distant from that community focus. What's been your experience with developing companies from, you know, where Adriana is kind of focusing, and now we're ramping up and we're making a whole lot of money and we're making some environmental impact and we're creating social justice, and now they need to get a new raise and they come to see you, Monica. What happens next?
Yeah, so as we defined ESG for ourselves, we definitely used and leaned on the Sustainable Development Goals quite heavily. I think ESG has been so broadly and variably defined over the years. It was first used as kind of a negative screening. It just meant you don't invest in alcohol, and tobacco, and guns. And then now it's become much more of a positive criteria that people are defining clearly. And so I think, you know, it's still I think it's problematic that every fund has to define it for themselves, because we don't have a GAAP accounting equivalent of what ESG means. But for us, we basically looked across the SDGs, and as we define our personal mandate, all of the SDGs mapping to environmental, specifically carbon reduction goals are sort of primary for us in terms of focus. And the SDGs related to more of the S and the G side, so things like tech-led transparency, social inclusion, financial inclusion, those tend to be a little more, it's not that we wouldn't invest in those companies, but we do take a second look to make sure that we are the right investors there as well, because that's just—
So it's more of a layering effect then?
It is with like the E on top and then the S and the G below. And a lot of that is just driven by what we know, what we've invested in before, and the expertise across our fund is largely focused on the E. So it's just being humble about, you know, where we can actually add value. And then as we work with our portfolio companies over their life cycle, diversity is definitely a point on which we help them level up. So we do that in a few different ways. One could be just by we have a network of diversity-focused executive search firms for board candidates, for executive candidates that we help connect our companies to. We have a network of talented people we've met over the years who we help connect our companies to, just to help them build that diversity from that stage at which they're often leveling up their executive team, rethinking their org structure, et cetera, because they're scaling. And so that's a big one that we work with our companies on. In terms of reporting, we ask, and our LPs also ask, for a certain set of metrics, largely on the carbon emission side. So since that's a focus for our fund, what is the relative carbon impact of each of the portfolio companies? And then on diversity and inclusion, at this point, it's a little more of reporting than a push, but we're at least just starting with that, on having each of our companies report how many board members, how many executive team members are minorities. And then over time, the thought is that you measure what matters, and then you help them manage it. And so we then help nudge them with introductions to those executive search firms and talented people that I've mentioned.
Excellent. Dan, you make more personal connections, one-on-one, your decision-making around who you're going to invest in and your portfolio management is all up to you, buddy. So how do you address the SDG goals and the ESGs?
Yeah. Yeah, I guess as I think about it, like sort of, well, I think for all of us, I think like screening is less of a, it's sort of like, it's baked in, because I think to have the conversation with Monica or Adriana or myself, the kind of like your commitment to at least environmental, at least the E is sort of table stakes. And at least that's the way that it's been. And I think, as sort of like this, sector heats up and more startups enter the ecosystem, potentially there could be a day where, not every founder that comes to your, to your table sort of like eats and sleeps, climate impact and social impact. I thought it was a really interesting point that Adriana said about like sort of, Series A, let's say, being too late to put a lot of rigor about thinking about impact and sort of channeling intentions and motivations into a more rigorous framework about, like Monica was saying, measuring and optimizing. I really like that idea that early stage startups, kind of all the balls are in the air at the same time, but it's also the right time to build the muscle memory around around these ideas.
Yeah, that's a good point. The muscle memory is a kind of a really important thing. If you get started early, you maintain that momentum right through until you get to Monica, and then Monica has to make a decision what she's going to do with you. And so on that point, then, the kinds of startups that you're seeing coming through across your desk, what's kind of the hot markets, the sectors, what's growing, what's not, and particularly as it pertains to artificial intelligence and AI, how is that playing a role in the way that we're approaching our investments and our investment portfolios moving forward? What are the hot markets? How are you making the decisions to expand into those? I'm sure that these days they're not all greenfield kind of markets. So but how is that investment portfolio changing, and what kind of companies? How is it related to AI as well? Yeah, anyone, please.
I can start. I think also sort of like piggybacking off of the last question. I think that the way that downstream public markets investors deal with ESG, SDG, climate, intelligence. This is a market that this is an idea that has gone from 0 to 60 so quickly, and the way that the chips have fallen, and the way that people are using ESG data to build portfolio strategies is not nearly as impactful as it can be, and I think same with like sort of integrating climate intelligence and climate projections, and thinking about physical and economic climate risk to different parts of the economy. I believe, especially kind of having had most of my career in capital markets, that giving markets the tools to price that risk will result in a sort of a virtuous cycle that ultimately leads to a lot more capital being funneled towards climate solutions, which is something that we need very much. And I think that AI, for example, is a tool and a way of taking a lot of data about the world and turning it into insights for investors and for markets that can kick off that cycle.
So you're saying that that arbitrage will drive the future investments in particular sectors, and that AI will provide the kind of the data streams that we need in order to make better decision making. Yeah.
Yeah, piggybacking off of that point on capital markets, I think an interesting application we've seen has been natural language processing. So people basically mining 10Ks, press releases, tons of unstructured data to help surface ESG risks and climate risks, et cetera. So that's been a category that I've been excited about. There are companies like Primer and Amenity Analytics that are really focusing on helping financial institutions like track and surface sentiment, and then eventually that I think will become more sophisticated over time into risk and ESG analysis as well. An application of AI we've been really excited about is around computer vision. So how can you take all the incredible learning that's been happening and the investment that's happened in autonomy and apply that into the sectors we often invest behind. So energy, infrastructure, construction, et cetera. So for example, remote monitoring solutions using visual analytics for construction projects and tracking. I think that's a space that's really exciting. And with COVID, basically all these industries that had been a little bit slower to adopt some of these technologies had just been forced to figure it out. And I think that that's been such an incredible Kickstarter for so many of these technologies and so much of digitization of these old school industries. And so the concept of digitizing industry and applying AI and computer vision in these heavy industries was something we were excited about before, but I think post-COVID we're even more, we're leaning in even more behind the theme.
But we've got a bit of a disconnect though, don't we? Because given that we need all this data and we need it driven by AI to make better decisions or inform those better decisions, we then need a whole lot of sensors and hardware in order to pick up all that data. And for the most part, investors are reluctant to invest in hardware. So how do we reconcile that? You know, on one hand, we have this need, we have this kind of dire urgency, if you like, and on the other hand, we are reluctant to invest in hardware. Adriana, do you want to address that? I know that you have Lacey companies are definitely working in the hardware space. You know, batteries and all kinds of stuff. How's that affecting your investments?
Yeah, for sure. I mean, we have these conversations every day, right? All of our
I don't
want to see so many hardware companies, and we're like, no, this is really important. So, you know, that's been like the Cleantech problem for forever. But the really big message that we always have is like these things they're necessary, right, to adopt the AI solutions that are being presented. And we have some within our portfolio that are also software oriented and are using AI. But we also have, you know, a big portion of our startups are really kind of working head on to think about hardware solutions. One of the ones that I'm really excited about is Automotus, that's using AI specifically to think about curb management, especially as we think about how cities, you know, were once so congested. We're seeing, you know, I'm in LA, we're seeing so many, we're all in LA, but we're seeing
not enough parking meters, never enough.
Yeah, not enough parking meters. There's not enough, you know, so many of our disadvantaged folks that are underrepresented folks that are doing Uber or DoorDash or getting parking tickets that they can't afford. And so we need access to curbs. One of the things that we're doing right now, Lacey is doing a zero emissions mobility pilot out in Santa Monica with a bunch of our different startups to kind of think about how we can include both hardware and software oriented solutions. Yeah, so it's really exciting. I mean, from the mobility space to the transportation space, especially when we think about circular economy and how the life cycle of products are affected by software, but also by hardware. I think it's, you know, really important to kind of think about the availability of both and the necessity of both. And while we don't necessarily see the same investment returns from hardware companies, they're equally as necessary. And so we're always trying to convince our investors to look at our hardware solutions as well.
Speaking of returns, then I'm going to go back over to Monica because exits. What kind of exits are we seeing in things like this kind of sector that includes, you know, everything from energy, circular economy, ocean and maritime, logistics and supply chain, transportation? How everything that kind of swirls around, you know, clean tech and these climate goals. What are you seeing insofar as exits are concerned? So what's been the returns and where are the exits? How are they related to the kind of the hot industries? And what are we seeing? What's gonna happen in the next post-COVID recovery? You know, clean, green and blue led, you know, startup companies. How's that going to change?
Yeah, so we were seeing a surge in interest in public markets for ESG, even pre-COVID. I think it started probably in Q4 of 2019. I think you can just track that this Tesla stock really just see how much that's increased over the past, let's say, 6 quarters or so. And I think with the Biden infrastructure plan, the stock market, like there have been incredible exits in our sectors. I think the big ones, of course, electrification has been a particular favorite of a lot of the SPACs that have gone out in the last couple of quarters. And then, but frankly, a lot of themes around climate. AppHarvest, which is not a portfolio company of ours, but is a vertical farming company very much aligned with this concept of having a more sustainable, more local supply chain for fresh produce. They went public at, I think, over $1 billion just a month ago. And so we're starting to see more and more of these really incredible public market exits for several companies across different categories of sustainability. Beyond Meat and Phase are all examples of companies that were doing pretty well before 2019 and have been doing incredibly well since then. So I think the pull that we're seeing from public markets has been creating a really great set of exits for companies. And then also, as the stock off Tesla, off Enphase, et cetera, goes up, it does give those companies opportunity and more flexibility for M&A and consolidation. So I think we haven't yet seen much M&A happening, but I could see that being also an interesting exit for companies in our sectors as all both sort of rise.
How's it relate to the private equity that's floating around?
So there's a lot of capital, both private and public, floating around. So there's definitely some question of how much of this is driven by asset bubbles, but I do think that there are a lot of real forces behind it. So one of them being the falling cost of batteries at this point, particularly for fleet vehicles. It's actually the better economic decision to go invest in electric rather than internal combustion. The cost of solar has come down so much that it's cheaper to build new solar than to run existing coal, and cheaper to build new solar than to build new gas. So I think those two factors alone, plus of course the incredible fiscal stimulus that's coming in when the Biden plan gets approved, I think all of those are driving a lot of the growth in the real, in a more real sense and less nominal fiscal sense.
Yeah, and what was the vertical farm company that you mentioned before?
I mentioned AppHarvest, but I also Aero Farms is also doing a SPAC, and I think that was announced a week or two ago. So we're going to see more and more of these. Yeah,
and plenty's in downtown LA and in South Central. So yeah, that is another large area that's kind of growing as well. Dan, are you seeing something similar from your end?
Yeah, I don't have a lot to add. I think, maybe also that, I think arguably a lot of people, believe that we're seeing that retail investors have more power as well. And, a lot of these stories in the public markets have been buoyed by retail investors and people who I think align their investments with their principles and really haven't had a lot of options to do so in public markets for a long time, and now now they do, and there's alignment there.
Right. So we're running up to our time. Can't believe it's already 45 minutes.
But
I know, right? But I wanted to. We raised the specter of impact and what that might mean earlier on. Adriana, you and I had just a brief tete-a-tete before about that. But I'd certainly like to expand upon it, because I think your idea of that kind of equity rollback plan for companies that create more impact, I think is an interesting one. Could you elaborate a little bit more about that, please?
Yeah, absolutely. I mean, one of the things that we realize is that as incubators, we are able to see nascent companies, at the really on the ideation stage. We have so many folks coming from colleges and universities being really excited about building out solutions that they will see, 10, 20 years down the line. And so one of our kind of key missions is to be able to incorporate impact into a startup and hopefully, see this impact or this initiation of impact laid upon the foundation of the startup for many years to come. And so, this has been kind of work that has been really from the past 5 to 10, we're 10 years old this year, Lacey is. And so about 5 years ago, we noticed that our startups really wanted to enumerate their impact, especially when they were talking to investors in the area. And a lot of folks, based on consumer trends, but also recent exits. And then because the investor network was getting more and more excited about clean tech, especially after kind of a dip about 10 years ago, our startups actually started asking for resources to be able to enumerate, how many GHGs they were able to avoid or whatever it is that they were working on. And so for us, it really came down to kind of understanding what was out in the market, both from the sustainable development goals. There's also IRIS metrics. There's also, the ESGs, and there's so many other kind of different metrics as I was talking about earlier. For us, we said, okay, well, how can we make sure that we're kind of taking from all of the different ones to be able to make sure that our companies were prepared in their conversations with investors? And then we created this framework. So our framework is a 1,400 point framework. It's 22 different metrics. And the idea here is to not overwhelm our startups with all of the different options for impact. Because, a lot of times when I talk to the founders that we work with, they're like, girl, I am focused on so many other things other than impact.
Yeah, and but a rubric is always going to be helpful, right?
Right.
Because
then
they know how they're going to track.
I don't have time for it.
Yeah.
And so making sure that we're, not making it a worry or a cause of concern, but more so something that is exciting and something that they as founders want to incorporate. If they don't necessarily care that much about supply chain, well, how can we make sure that they, are they excited about equity at their company, or are they excited about inclusivity? And most of the time, if not always, there's going to be, founders, especially when they're working within the sustainability space, are excited about one or the other. And so they're prepared when they're having conversations with investors.
Yeah, and it's like what Dan was saying before about muscle memory, right? You
exactly.
do things out of necessity to get that muscle memory and then build upon that. Yeah.
And you'll be surprised. So many of our startups come back and say, oh my gosh, Audrey, thank you so much for working with me, a year ago, even though I was super stubborn, because now I'm talking to XXX investor and they're asking me for these, and I'm not sitting at midnight trying to enumerate these impact metrics.
And you can put this in your data room and you can just
exactly
until it's ready to go. Yeah, absolutely. Monica, wanted to ask you about how it plays a role in your company.
Yeah, so for impact, we ask our companies to report largely on an annual basis the main metrics we track. So one is the inputs to our calculation of carbon emissions avoided. So usually it's classic business metrics, or similarly to Lacey, we're trying to make it as simple as possible for them. And yes, exactly, just like classic rubric. And then a lot of it is just like reporting on diversity, et cetera. And so that is helpful both for our own tracking of our fund's impact, and then also, of course, our LPs ask for that. I think that's largely how we do it. And of course, companies often go above and beyond. That's kind of a floor of what we have. For example, ShareTex in our portfolio is doing incredible work on implicit bias training and doing a lot of also external evangelism with other startup companies in Canada on how they can be more thoughtful on DEI. So I think I would cite that as an example of sort of going above and beyond. We don't mandate that.
Right. And Dan, finally, how do you measure impact? You're largely making these investment decisions on your own, and how do you measure the impact? How do you kind of assess, yes, this company will create an impact. This is kind of what I want to invest in. How do you do that?
Yeah, I think for me, I think when I sort of look at impact reporting, I think the frameworks that sort of make the most sense to me, or that are sort of the easiest to digest, I like to see like sort of mapping to SDG metrics. I feel that that takes something that's sort of very specific and puts it in like a global context. Yeah, and I think that that's really important for is that people can understand the way that small actions and specifics map to really big global forces, global goals. Yeah.
Okay, cool. We're coming up to our last 5 minutes. We wanted to try and get some final comments from you all. Dan, do you have any final thoughts? Anything you want to expand upon that we've talked about today? It can be something that you're kind of personally more interested in,
Yeah, no, I mean, I think that what we've been talking about here, I think like we're talking about the drivers of what I think is going to be the economy globally over the next 10 years, and it's it's not just a technology or a set of technologies around decarbonization and climate adaptation, but it's all or artificial intelligence, but it's a framework of investors and of capital thinking about how to maximize sort of returns and value for the world and profits, and I think it's the alignment of those two things. When those two things are aligned, I think that is the most powerful thing, and the thing that is going to make people in the space a lot of money and also help us achieve our goals.
So the incentive and kind of that environmental bargain that we've got to make as well. So yeah, that's good. Monica, your thoughts?
Yeah, I'm excited about the diversity of capital coming in. So I think for companies in clean tech, you really need, I think there's a whole variety of types of capital that helps them, all the way from, as both Dan and Adriana invest early stage, help them with that first incubation and that angel stage, but then also there's more growth capital coming into the space. I'd mentioned SPACs earlier to help with more of the exit side and ensuring capital as companies access the public markets. And then also project finance. I think in the first wave of venture investing in climate and clean tech, everyone was trying to and they had used the same hammer for every nail, and it was just tried to use really expensive venture dollars for every type of business model, including very capital intensive ones. And what makes me really excited is that now there's so many different types of capital providers, so excited about sustainability and supporting companies in the space.
Yeah, we found that challenges, like issuing a challenge, teases out some of those companies that you never heard of before, and from like some weird parts of the world that you don't expect companies to do those kinds of environmental work. It comes to mind a company from Budapest that has a way to regrow mangroves, and I'm amazed that a landlocked country can think about something like this and create something that is that can help regenerate mangroves. So I think that having these kinds of challenges kind of teases out these companies, these teams, and then we can find the kinds of capital that might be appropriate for those teams as we go ahead, as we move ahead. So whether it's like undiluted capital through grants and awards, or whether it's through early stage financing, either friends and family, angel, seed, pre-seed rounds, that kind of stuff, even a pre-accelerator, and then moving them, kind of progressing them through the capital minefield, right? So yeah, getting them to the stage where they're ready to really ramp that scale up, and then of course, Monica, they come to you, and then they've got to then they've got all that. Hopefully, they've got all that reporting. They've created that impact, and they can kind of justify where they are. Adriana, as wrapping up, would you say that's kind of the goal for Lacey as well?
Yeah, for sure. I mean, I was just thinking about our, we have a bi-weekly series called Lacey Investor Talks. I'd love to host each of y'all there. But, you know, we have folks from high net worth individuals all the way to family foundations, to venture debt firms, and then, of course, traditional VC firms. And what we always try to let our startups know and our founders know is that, you know, venture capital in the traditional sense is not the only way to go. And there's so many other options, as y'all were sharing. I would also just say to anyone who is participating in Earth Summit, thank you for joining on helping and thinking about the climate crisis. We don't have a lot of years left if we're still going the same way. So just cheers to everyone working on the summit, but also working on what we're trying to achieve. And if you're a founder that needs access to capital or access to support, please, I'm volunteering us, but please feel free to reach out to us, and you know, we're happy to share more information.
Yeah, likewise. I think any of us would probably be welcome to having a discussion. On that note, I'd like to thank everyone, each of you, Monica, Dan, Adriana, thank you very, very much for being panelists today. It's been a really exciting conversation. I hope to talk to you guys again very, very soon. Thank you very much.
Thank you, Jim.
Yeah.
All right.